$1. That's all it takes to turn your Medicare premium into a bill that's thousands of dollars higher. Not because you made a mistake, well, because you crossed a line you didn't even know existed. And the worst part? Well, you don't find out until 2 years later, when the bill shows up. This is the Medicare income cliff, and it's quietly breaking retirement plans built on the 4% rule. So before I show you the numbers, let's unpack this. Medicare doesn't care how much you have. It cares about one number, on one line, on your tax return. That number is called your modified adjusted gross income, and that's the income on your tax return, plus a few add-backs like the tax-exempt interest from the municipal bonds. Medicare uses this one number to decide your premium, not your account balance, not your lifestyle. One number on one line of one form, the Medicare cliff. So that's a line where your premium jumps. It's called the income-related monthly adjusted amount. In short, it's Medicare premium surcharge for higher earners. Cross that line by $1, and your full surcharge kicks in. $1 over can cost you almost $1,000 a year per person. And here's the part that most retirees never hear. Medicare does not look back this year's income to set this year's premium. It looks back 2 years. So the decision you make today becomes a bill 2 years from now. Keep all three ideas in mind: the income, the cliff, and the look back. Everything in this video turns on those three words. Start with the 4% rule. You see, Bill Bengen built it in 1994. He was the financial advisor, not a government economist. He ran the simulation, one retiree, one portfolio, 30 years. He took the worst market year in American history, someone who retired in 1966. He ran the numbers for 30 years, and 4% was the withdrawal rate that survived. Well, not the rate that worked, the rate that barely survived the worst case. Well, Bengen himself has updated the number. In more recent work, he put the floor closer to 4.7%. He has even floated 5% for many retirees. For someone retiring into a normal market, not a 1966 crash, even Bengen says he never meant it as a universal rule. It was a stress test. Well, a stress test everyone treats like a blueprint. Well, the problem is not the 4% rule itself. The problem is that no one ever added the second half of the sentence. 4% is safe for the portfolio. It may not be safe for your premium. So if 4% is the floor, well, what sets the ceiling? Well, in a minute, I'll show you exactly how $1 triggers a $2,000 jump. Because once you see it, you'll never look at withdrawals the same way again. Medicare sets a ceiling. In 2026, the standard Part B premium is $202.90 a month. Part B is the outpatient medical coverage side of Medicare. That's the base price. Most retirees pay exactly that. But if your modified adjusted gross income crosses a threshold, the price changes. There are 5 tiers. Below $109,000 single or $218,000 joint. You pay the base, $202.90. Cross the first line. You pay $284.10. Cross the next, $405.80. If you cross the next, it's $527.90. And if you cross the next, $649.20. Top tier, $689.90. Between the bottom and the top. And that's a difference about $5,840 a year per person. For a married couple, double it. Almost $12,000 every year. tied to what someone pulled from a retirement account 2 years ago. Most people assume Medicare premium is fixed. Well, it's not. Medicare premiums are tied to the income that shows up on your tax return. That one connection is where retirement plans break. Pulling a little more out of your traditional retirement account is the same thing as handling Medicare, a raise. And here's the part that breaks plans the most. Medicare does not look at this year. It looks at your tax return from 2 years ago. What you withdrew in 2026 sets your Medicare premium in 2028, which means a one-time withdrawal today, a Roth conversion, a big capital gain, selling a property, shows up as a premium hike 2 years later. And then the money is spent. Well, the premium bill is not. The lookback exists for a simple reason. Medicare has to set premiums before it knows your current income. It uses the most recent tax return Social Security has on file. Well, usually that's from 2 years ago, sometimes 3. Well, either way, the decision you made in 1 year becomes a monthly bill you open in another. You sit with the tax return in one hand and then the premium letter in the other. The numbers don't match, but they did 2 years ago. The math does not change. The year does. The retirement account has no memory of what you pulled out. Medicare does. So let me show you what a single dollar can do. So let's say you're married, both on Medicare. Your modified adjusted gross income lands at $218,000, exactly on that line. You pay the base about $202 a month each. You change one thing, you pull an extra dollar out of your traditional IRA. $1. Your modified adjusted gross income is now $218,001. Your Part B premium jumps to $284.10 each. So that's about $974 a year per spouse. $1,948 for the household. For $1 over the line. Push it farther, $274,001. $405.80 a month each. Well, that's just under $2,435 more per spouse per year. Almost $5,000 for the household, all from how you structure the withdrawal. Not how much you earn, how you earned it. There's also a Part D surcharge riding on top. Part D is Medicare's prescription drug coverage. At Tier 1, it adds about $14.50 a month. At Tier 2, about $37.50. At the top tier, $91 a month. That's another $1,000 a year at the upper bracket per person, none of which shows up until your accountant opens a premium letter. The 4% rule protects the portfolio. Nothing protects the premium. And there is one piece of this most people never see. Social Security counts. Your Social Security check shows up in modified adjusted gross income, up to 85% of it for most retirees, which means claiming age is not a retirement decision. It's a Medicare decision. Claim at 62 and you are stacking Social Security on top of whatever. You pull out of a traditional retirement account every year for the rest of your life. A $40,000 annual security check adds about $34,000 to your modified adjusted gross income. That alone can be the difference between Tier 0 and Tier 1, or between Tier 1 and Tier 2. Delay Social Security to 67. Take smaller Roth withdrawals between 63 and 65. So your modified adjusted gross income is smaller. In the exact years Medicare looks back, qualified Roth distributions generally do not increase the modified adjusted gross income Medicare uses, which means the same dollar coming out of two different accounts is not the same dollar at all. One triggers the cliff, the other does not. So one household with identical account balances, same lifestyle, same spending, can pay Medicare premiums that are $3,000 a year apart, based on one thing: which account they pull from first. The fix is simpler than most retirees think. Sequence matters more than account. In the years before 65, you have the flexibility to shape the tax return, Roth conversions while you are in the lower bracket, capital gains harvested up to the 0% long-term rate, drawing down taxable accounts before tax-deferred ones, using the gap years to create tax-free income for later. The window between 63 and 65 is the quiet one. No Medicare yet. No required minimum distributions yet. Required minimum distributions are amounts the government forces you to pull from retirement accounts starting at 73. Whatever you pay in tax during the window often prevents a much bigger Medicare bill later. So at 65, the game changes. The plan is not about pulling 4%. It's about staying under a specific line every year for the rest of your retirement. For retirees already on Medicare, there is one more door. If your income dropped because of a life-changing event, retirement itself, job loss, divorce, a spouse passing, you can request a Medicare premium appeal form. And that's the form retirees file to lower their premium after a big life change. So the Social Security Administration has to approve it. But thousands of retirees every year get a full tier drop. So call Social Security at the number 1-800-772-1213. Check online to make sure. Medicare.gov also /lower-IRMAA as the current rules. So write down both. There are two tools that undo this damage, if it already happened. So let's put the spreadsheet down. So breathe a little. The plan holds $1 over the line, $1,000 in Medicare. Does that sound fair? Well, none of these numbers are prescriptive. They're just the math of the system. But if you're retiring in the next 5 years, the 2-year look back starts the day you take that first big withdrawal. So if your spouse is already on Medicare, every joint tax decision is a Medicare decision. So if you are already retired and drawing Social Security, your next Roth conversion is also your next premium decision. So the 4% rule is a stress test. The Medicare bracket is the bill. The portfolio does not care which dollar you pull. Medicare cares a lot. And once the 2-year look-back clock starts, the decision you made is already becoming the premium you cannot negotiate unless you know the appeal exists. Well, one last thing. The numbers I share with you are from 2026. The decisions are yours. And if you already retired, or if Medicare is 5 years away, tell me in the comments. What is your plan for the 2-year look back? I'm Han Brown, and this is The Han Brown Show. And I'll see you in the next one.